Right. We are live. We'll just wait 10 seconds or so as people trickle in. But as you come in, please feel free to introduce yourselves in the chat. Let's be social. Say hello, where you're tuning in from. Remember to switch the message to all attendees so that everyone can see it. Right. Well, as we wait for more people to trickle in, we can definitely get started. So hello, Fitemizers, and welcome to another Fitemize Live. My name is Reda, head of content here at Fitemize, and I'm really excited to host today's event on active strategies for intelligent investing with our partner, State Street Global Advisors. Before we get started, just some kind of quick housekeeping rules to run through. So first of all, like I said, please feel free to introduce yourself in the chat. Tell us where you're tuning in from, and be sure to switch your message to all attendees so that everyone can see. Second of all, in terms of format, this is going to be a 15-minute discussion with our guest today, followed by a 15-minute audience Q&A, which takes me to my third and final point. Please use the Q&A box down below to ask a question. And if you see a question that you like, upvote it. That way it moves up to the top and we can get through the most upvoted questions first. So without further ado, let's get started. So like I said, today's session is brought to you in partnership with State Street Global Advisors. If you're not familiar with State Street, they're committed to delivering well-crafted and innovative ETF solutions to help investors execute their investment strategies, no matter how complex. And if you want more information on their full list of ETF products, market insights, investment ideas, and ETF education, and loads more, you can visit the link that we're going to drop in the chat down below. Now, of course, no finance event is complete without a very quick disclaimer. So look, everything we're going to talk about today with investing, your capital is at risk and nothing is financial advice. And obviously your tax treatment depends on your own individual and personal circumstances, and of course, may be subject to change. Now, with that out of the way, I am really pleased to introduce today's guest, Ian Kolman, Director of Liquid Active Strategies at Galaxy Asset Management. So Ian focuses on all actively managed liquid crypto and crypto-themed investment strategies. And prior to joining Galaxy Asset Management, he was a portfolio manager at DV Trading. Previously, he began his career at Ronin Capital, where he was an investment analyst. Ian, it's a real pleasure to have you with us today. How are you doing?
Doing well. Thanks for having me. Great to be
Thank you for being here. Well, lots to talk about today. So without further ado, I really want to, dig in. And perhaps the first question to you, Ian, is, look, blockchain, digital assets, obviously constant innovation in these spaces. Very curious to hear your thoughts. Where do you see the most significant growth opportunities over the next, say, 3 to 5 years?
Yeah, I see significant growth potential in the kind of payments and stablecoin realm of blockchain. Stablecoins, they're one of the killer use cases that have come out of crypto, and it's really found product market fit. It started as a better tool for crypto trading, but more recently it's evolved into being used a lot for cross-border payments. Like I said, it started as a tool for crypto trading. Originally, the first set of crypto exchanges, they couldn't or wouldn't get banking relationships, and so everything you had to trade everything versus Bitcoin, and that kind of created its own challenges. You really want to have kind of a um, the base currency to be kind of more stable than Bitcoin, especially, it was very volatile back then. So really stable coins were developed to solve for that, but now it's turned into a powerful alternative to traditional payments. It's just a faster, more costive way to transact. So the example we like to give is, imagine you're trying to send someone an international wire. How long does that take? How much it cost? And you cross your fingers, pray it gets there. Stable coins, it's low fee and near instant. There's over 200 billion of stablecoins currently out there. That's up over 50% from last year, and we only expect that trend to continue. Also related to stablecoins is the trend of tokenization of real world assets. So that's the process of converting some real world asset and turning it into a digital token on the blockchain. Stablecoins, they're effectively a tokenized version of the US dollar and give anyone with internet access to dollars. And we kind of, take that for granted in the US, but I see it's a pretty big international audience, so I think they get that point a lot better. Um, Larry Fink, he had an entire section dedicated in his annual chairman's letter to tokenization, basically coming to the conclusion every asset can and should be tokenized. And then I know we're discussing digital assets, but I am also excited about AI. And there's a very unique interplay between publicly traded Bitcoin mining companies and AI. So I'm sure everyone knows there's a massive demand for high performance data centers. Everyone's using the generative AI tools, and the hyperscalers are, making significant investments in that. Even despite tariffs and market uncertainties, they're plowing ahead. So it's an arms race to really come up with the best AI model. And so the options are, if you're a hyperscaler, you can wait and build a data center from scratch, and that can be a lengthy, costly process, or you could rent or acquire space from a Bitcoin miner. And the oversimplification is you basically just unplug their Bitcoin miners and plug in your GPUs, and then you can run AI training and AI inference.
It's a very interesting use case of Bitcoin miners, an additional perhaps revenue or an alternative revenue stream that I didn't think about. That's really exciting. And are those GPUs typically used in Bitcoin mining suitable for AI applications?
No, unfortunately not. But the Bitcoin miners, even though they need to really retrofit everything, not just the GPUs, but networking, cooling. Um, but the main thing is that they have access to the power, and in the U.S. at least, power is the main constraint for these AI companies. And the Bitcoin miners, they're mining Bitcoin, and for better or for worse, their revenue is tied to the price of Bitcoin, which is pretty volatile. And usually the market kind of gives a discounted valuation when you have that kind of earnings volatility. And so they can sign these more stable, recurring, long-term leases, and it's denominated in US dollars. And typically those will get valued at more of a premium. So even though they can't use the same GPUs, the companies are very interested in exploring this opportunity.
Yeah, absolutely. So swapping out volatile earnings tied to the price of Bitcoin to more kind of recurring, visible revenue streams makes perfect sense. So next question for you, Ian. With so many emerging digital projects out there, like every single day you hear about a new, digital asset project or crypto project and so on. How do you personally, as an investor, differentiate, what's legitimate technology-driven opportunities from projects that are more speculative or hype-driven?
Yeah, so sometimes I would like to say you got to put on your venture capital hat when you're researching some of these digital asset projects. There's a lot of similarities between the two. You're investing in kind of emerging, innovative technologies that, the future may be uncertain, but has significant potential to really disrupt what's going on. So, like a venture capitalist, you need to consider product market fit, total addressable market. So, whether the product meets the needs of a market and solves an actual problem, and the potential market size and growth opportunities for solving that problem. So, specifically for digital projects, you look at token economics, also known as tokenomics. You want to see a kind of well-designed token economy that, aligns all the incentives. So you really ask yourself, what's the token's utility? What's its use case? Why is there even a token? How does the project generate revenue? And what do they do with those revenues? Do they just add it to their treasury and keep it themselves? Do they distribute it to the token holders? Or do they use those revenues to buy back and oftentimes burn the token, reducing the supply? Then you also need to look into the ownership supply structure. Is only a small percent of the token circulating, and then they're going to continually distribute more newly issued tokens over the course of a couple of years. And who are the current owners? Are they going to be long-term holders with you, or are they going to be consistent sellers? So you have the product market fit, TAM, total addressable market, and that helps you evaluate the project's potential. But then you need to look at the current valuation and compare that to what it's currently worth. So, if a project's, valued as if it's already super successful, when in reality it's still trying to find that product market fit and has little current revenues, it's probably best to move on to the next opportunity.
Makes perfect sense. Thank you, Ian. And when it comes to, because crypto is a whole new and different asset class, right? So when it comes to retail investors trying to incorporate this asset class, crypto, into a diversified portfolio, how do you think they should kind of go about doing that?
Yeah, as you said, it's a new asset class. Gaining exposure right now has never been easier. There's so many options available, but just taking a step back, just a quick history lesson on, the being able to invest in digital assets. So first, it was just, digitally native exchanges where you could just buy tokens, and historically, some of them have had a lot of issues. Most infamously, Mt. Gox back in 2014 got hacked, and then eventually there were CME futures products and that paved the way for the first set of ETFs, which track those futures contracts. And then last year, we finally got the spot ETFs, and that actually holds the underlying digital assets. And now we even have options on those ETFs. And then there's the whole wide world of publicly traded crypto equities, which is very interesting as well. And we refer to that as the digital asset ecosystem. So as I mentioned, there's, Bitcoin miners. They started to go public in the 2017, 2018 cycle, and they play a crucial role in securing the network, and they can get you exposure to Bitcoin without you actually having to buy Bitcoin. And as I mentioned, some of them are trying to diversify their revenue streams away from Bitcoin into AI and high performance computing. There's also crypto exchanges. That's another option to get exposure without actually having to buy digital assets. Then there's a whole slew of payment processors and stablecoin solutions, and they should just benefit from the increasing adoption and usage of stablecoins. Like I previously mentioned, you got hardware infrastructure companies, the companies that make the GPUs that the Bitcoin miners use, financial services companies, there's crypto native versions, and also traditional finance companies are getting involved in digital assets now as well. And then, of course, there's, companies adopting Bitcoin, treasury strategies, and other cryptocurrencies as well. And then there's, a ton of passive and active ETFs for this whole digital asset ecosystem. And the universe just continues to grow. There's been a dozen new names coming public recently, and, plenty more filing to go public in the near future.
So the opportunity set has been, ever expanding with time, which is absolutely great to see. I want to touch on something you mentioned when you were talking about ETFs, and you said now there are, active ETFs and passive ETFs, which is also really fascinating to see. And kind of from your perspective, what are the advantages of, gaining crypto exposure or exposure to blockchain through actively managed ETFs? And are there any scenarios when a passive investment might just still be the, preferable option?
Yeah. For actively managed ETFs, the biggest advantage is just managing risk. Bitcoin and crypto generally has been volatile. It's a new asset class, had limited adoption, lower liquidity, and in the past was used for speculation, and that leads to leverage, and then liquidations, which can extend moves in either direction, just increase the volatility. So Bitcoin's volatility has been high. It's been trending down over time. It's actually somewhat similar to stocks these days, which are pretty volatile last month or so. And that underlying crypto volatility actually flows through to kind of the digital asset ecosystem. Anything that has exposure to crypto will have kind of higher volatility. Um, but it also, the volatility, increases risk, but it also provides opportunities that actively managed portfolios can take advantage of. Actively managed, hopefully they're experts in the space and have, proper risk management strategies. Otherwise, you need to just be constantly monitoring the market and the space yourself, crypto markets, traditional finance markets, and, believe me, that's more than a full-time job for somebody. So a lot of times it's better to outsource that. But passive still could be preferable in certain cases. If an investor has done sufficient due diligence themselves, they believe in the potential of what they're investing in, and they're willing to ride the volatile growth curve without actively trying to time the market, passive could work. But you really need to be willing and able to not watch the markets on a daily basis and just hold, which is easier said than done a lot of times.
Absolutely, absolutely. So in terms of, just digging into these actively managed ETFs specifically, and I'm sure there's a lot and there's more coming out, every day. Like what criteria should retail investors use in terms of selecting these actively managed ETFs for digital assets specifically?
Yeah, it applies to all ETFs, active and passive, a lot of this. So really you need to, make sure the ETF it aligns with your own personal investment goals and your own risk tolerance. And you need to understand the ETF's underlying assets. What are they actually holding, and how do those holdings fit into your overall portfolio? You should choose ETFs ideally from established issuers, and you should look at digital assets have a shorter track record, but you should look at the ETF's historical performance and compare it to its benchmark. And then specifically for actively managed ETFs, you really need to understand the ETF's investment approach. What's the fund manager's experience? What's their decision-making process? And, especially what's their risk management process?
Makes perfect sense. And you touched on, throughout kind of the past and your history and all that, that traditional financial institutions have been, slowly embracing digital assets. And I'm just also curious to hear how do you think growing participation from institutional investors can influence the wider, crypto market? It used to be a market dominated by a lot of, retail investors, but now you're getting a lot of institutional investors participating. How does this kind of change the market, if any?
Yeah, it's definitely changing the markets. The institutional adoption is coming from pension funds, endowments, other large investors, and governments are even getting involved, adopting it, putting in their reserves or sovereign wealth funds. And a lot of what's driving that institutional adoption is the regulatory clarity that we're now finally getting for the industry. In the last administration, it was very much regulation by enforcement. Almost all those enforcement actions have been dropped, with the current administration. The SEC now, they specifically created a digital asset task force, which is going to work with the industry, communicate with the industry, which the SEC, previously wasn't really doing much of, and come up with common sense regulations that work for the industry, but also protect investors. And it's not just the SEC; it's coming from the top. President Trump, he hosted the first White House crypto summit, and out of that came the executive orders establishing the strategic Bitcoin reserve and the digital asset stockpile. And Congress is getting involved too. There's a pair of stablecoin bills making their way through both houses of Congress, and it seems to be a rare kind of bipartisan effort. And so now more than ever, with that regulatory clarity, traditional financial institutions kind of have the green light to come in and participate in the industry. And then overall, more institutional adoption should bring increased liquidity to the space and also reduce volatility as well. And specifically for Bitcoin, generally is seen as kind of the store of value. It's got its limited 21 million supply. So as more institutions get involved, more corporations hold it on their balance sheet, more governments hold it as a strategic reserve, you know, you'd expect to see Bitcoin kind of have a lower beta to equities kind of going forward.
Makes perfect sense. Thank you very much for that, Ian. Now it's time to kind of hand over to audience Q&A, where we're also going to be joined by Max Gold from State Street and answering these questions. And to everyone participating, I see a lot of questions already in the Q&A, but please, if you have a question to ask any of our guests today, feel free to put it in the box. So starting off with the first question, which is basically when investing in ETFs, how much should we pay attention towards hedged and unhedged versions of the same investment strategy, given the uncertainty of the dollar dominance? I assume this means currency hedged or unhedged.
Yeah, it's more important than ever, right? What currency do you want to be denominated in? What currency do you want to, kind of benchmark your returns to? In the past, even like 6 months ago, I'd say, it really doesn't matter too much. Just, kind of use the dollar denominated version. But, if you have more faith in your native currency, you need to look at a lot of macroeconomic indicators, kind of what's the monetary policy of the currency you're looking at. What does the yield curve look like? And what drives that is, typically the central banks and, the economic inputs that they're looking at, typically unemployment, GDP growth, inflation. So you kind of need to have a full picture of what's going on there to try and predict what the central bank's going to do, which in turn should affect the currency. But as you know, also fiscal policy matters a lot as well. So it's a whole mosaic there you got to keep track of.
Thank you very much. Then the next question is asking, what are you using to drill down into the flows of revenues and expenses for particular digital projects?
Yeah, typically, a protocol or a project, if they're, pretty good, they'll have their own kind of web page with a dashboard that has a lot of their kind of internal statistics on there that you can track. I don't want to give anyone a free shout out, but there's a lot of good and a lot of times free aggregators of this information that pull it across different layer one protocols, uh, different layer ones, layer twos, different protocols, and kind of aggregate it so you can kind of compare and do your best to come up with sort of like a income statement for a lot of these protocols. But there's a lot of free tools out there. I promise you.
Thank you very much. And then next question. It feels like the demand for and on GPUs is surging. Is it worthwhile looking at funds that lean into acquiring or owning these centers and machines?
Yeah, you should definitely look into it, but there's a lot of different angles to kind of play the AI angle. Kind of the first wave is NVIDIA with the GPUs and the GPU angle now, AMD, Intel, Huawei in China is getting involved. But there's, more than ever, there's a lot of uncertainty there, especially with tariffs. I believe the administration just banned NVIDIA from selling their H20s, which were specifically designed to kind of be less efficient, less productive than the ones domestically that they were going to sell in the US. So there's just a lot of uncertainty there in terms of who the main GPU provider is going to be, especially, things like DeepSeek showed everyone that, you don't even need the latest, greatest GPU necessarily to kind of produce the latest cutting edge frontier model. So it's something I'm constantly looking into, and it's the landscape's ever changing with a lot of news. But in terms of GPUs is one angle, data centers, and Bitcoin miners who have these data centers with these power contracts are another angle. The inputs into the data center, the networking solutions, the cooling solutions, and the power, who's providing the power. So all these are kind of different angles you can look at when trying to, thematically try and trade kind of the AI.
Makes sense. Thank you very much. The next question is saying, I'm curious, what do you think if more and more people hold their assets in digital assets instead of dollars or fiat currency? Will that lead to trouble at banks?
Yeah, I don't, obviously if 100% of people took their money out of the traditional finance system and put it into digital assets, that would be trouble for banks. But I just don't think that's a realistic scenario. I think when Bitcoin was first created, that was kind of the notion they wanted to get, that it was a completely separate, monetary system. But I think as the industry's evolved, it realizes it's more of just kind of a complement to the existing system, and also sometimes an escape valve. Like during Silicon Valley Bank, if you're not trusting the banking system, you have an alternative that you can choose to go to. But also, increasingly, as I hinted at, the banks are more and more getting involved in digital assets. So, in theory, if, enough people, you want to put your money into digital assets, that could be custodied at a bank. So it wouldn't necessarily break the banks because they're also kind of getting involved in the industry and as well. So you're just taking it out of a normal checking account and putting in a bank's kind of crypto custody account.
Makes sense. Thank you very much. I guess related to that is, what happens with potential central bank digital currencies, right? Because those are easier to move out of the bank and just hold at the central bank. And what does that mean for banks?
Yeah, I think central bank digital currencies, it's to use blockchain technology kind of on the back end instead of what's it called? I believe Fedwire is the one that the Fed uses. I think the underlying technology can be used on the back end, but to have everyone be forced to use a central bank digital currency, the biggest downside to that is, effectively the government can crypto, it's, kind of anonymous, while it's anonymous, but, every transaction's on the ledger, on the public ledger. So in theory, if everyone's forced to use a central bank digital currency, then the government could be tracking everyone's personal transactions and kind of, that's one of the downsides to it. But in theory, having the back end of the monetary system that the central bank uses and the banks and the central banks use, that, having that be crypto rails, that's a positive.
Makes sense. Next question is basically saying that during my education and training as an investor, I have learned that any investment that doesn't pay interest, collect rent, or have earnings is speculative in nature. What is your perspective on digital currency? Are they purely speculative? If so, why or why not?
I do generally agree with that statement. My background before getting into crypto and digital assets was more of a kind of fundamental value investor background. So overall, I do agree with that statement. And, I think a lot of people write off crypto as not having any earnings. But, as I mentioned, when you're looking for these good digital projects, a lot of them do have earnings. Some of the decentralized exchanges, if you're swapping, Ethereum for Bitcoin on one of these decentralized exchanges, they clip a fee every time you do that, and they do accumulate revenue. That's just one example. Layer ones, anytime you want to transact on Bitcoin or Ethereum, you need to pay, a fee in Bitcoin or Ethereum to do that. So there is, that utility and need for the token, outside of just collecting revenues.
Thank you very much. Then we have a question, I guess, following up on the earlier question on project revenues and expenses. This question is saying, I can see, for example, this March, Ethereum had expenses of 165 million, revenues of 8 million. How can this be considered a going concern? And how do you underwrite an investment into a project like this?
Yeah, I'm not exactly sure how a lot of people, crypto's not, it's very analogous, but it's not exact one to one. Like what's exactly a revenue, what's exactly an expense. But just generally, you know, specifically for Ethereum, back in the kind of DeFi boom, it was very expensive to do any transaction on Ethereum because there was a lot of demand. And as I mentioned, there's that fee you have to pay to submit a transaction on the chain. And it's dynamic and it scales with, how much demand there is. So if there's more demand, it costs more to do a transaction. And so Ethereum's solution to that was to have what they call layer twos, where you can do transactions much faster, much more cheaply. And those layer twos kind of aggregate and then batch those transactions that happened on the layer two and then post that to the layer one. And so kind of over the last year or two, as these layer twos have really expanded and become more popular, and most people are kind of doing the same type of transactions they were previously doing in the layer one, they're now doing in the layer two. Kind of the fee economics on Ethereum are not as basically, because it's cheaper for everyone to transact on the layer two, the Ethereum base layer isn't generating as many fees as it once used to. So that's kind of one of the big questions of Ethereum right now is how do they solve for that?
Thank you very much. And next question, do you think it's a good idea to invest in crypto during these unpredictable economic times?
Yeah, it's always a good time to invest, but with any investment, it's always what size are you going to invest your full allocation that you were going to invest in crypto right now? Probably not. Is it a terrible time to put a little bit of capital to work? Probably also not. So it really has to do with sizing. Always with trading and investing, it's about sizing. But one, the unpredictable economic times, it's probably alluded to tariffs, but a recent development lately has been, Trump's been coming down hard on, the chairman of the Fed, Jerome Powell. And so that kind of interplay, and the Fed's very much supposed to be this kind of independent actor, not swayed by, 4-year cycles, the 4-year terms of the election cycle, and, try to be nonpartisan. So, President Trump trying to kind of influence the Fed, I'd also consider that unpredictable economic times, and, the Fed losing its independence could arguably be, beneficial for digital assets and, specifically Bitcoin if they're forced to, print more money or lower interest rates when they otherwise wouldn't.
Absolutely. And I think we have time for one final question, which is basically asking, what are some ETF options for individual investors to capture digital asset trends?
Yeah, I'm happy to jump in on that one. My name is Max Gold. I'm with State Street Global Advisors. And I think that gives a good opportunity for me to spotlight, our partnership with the team at Galaxy and with Ian and his team that we're really excited for in the US. We've launched a suite of US ETFs focused on tackling and providing exposure to technology accelerators that are disruptive and transformative technologies and the ecosystem behind that, as well as a few digital asset ecosystem ETFs. One is sort of gives you the exposure, and then one that gives you some kind of hedge protection to help mitigate risk to a certain extent. So we're really excited to partner with Galaxy on the suite of US ETFs that are listed in the US for US investors, around leveraging their deep understanding of the digital asset ecosystem, of blockchain technology, of the crypto space that was on display with Ian's conversation today, and really to leverage that expertise for actively managed ETFs that we have offered in the US. So certainly I encourage you visit our website at ssga.com to find out more about how we partner with State Street and Galaxy to offer up some ETF solutions that are actively managed to help provide some dynamic exposure to some of these trends and some of these themes that we're in discussion here today.
Amazing. Thank you very much, Max. Thank you very much, Ian. I'm afraid that's all the time we have today. Thank you so much, Ian. On behalf of myself, Finimize, the entire Finimize community, thank you so much for your insights. That was really, really useful, really great stuff in there. So thank you so much.
Yeah. Thanks for having me. Wonderful.
And everyone, as you leave the event today, a pop-up survey will appear on your screen. Please take, it's super quick to fill. Just let us know what topics you're interested in hearing about at future events. Thank you for joining us today. Ian, thank you once again, and we'll see everyone in the future.
Take care, everyone.
Bye-bye.